Today we're going to talk about the impact of the volatility in natural gas prices on pulp and paper producers. Some headlines we saw recently drew our attention to this issue over the last few months. One of those headlines was about Verso Paper's decision to close their Bucksport facility for a couple of weeks because of, in part, because of a spike in natural gas prices. Bucksport's a pretty sizable operation, and it caused us to think that if gas prices could cause a facility like that to shut down, we should probably examine this, particularly since that shutdown of Bucksport came on the heels of some other curtailments and shutdowns of mills that had been announced in prior weeks and months that were also attributed to spikes in natural gas prices. So as we think about this issue, we know that natural gas prices are expected to rise in the midterm, but there's a great deal of uncertainty about just how much the price of natural gas might change. And we thought that if these unexpected changes in natural gas prices could cause a mill to have to shut down, it posed a number of questions that we thought worthy of further examination. For instance, are there certain segments of the pulp and paper industry that are just more sensitive to natural gas volatility? And then within those segments, are there particular companies that might have more exposure and therefore greater financial risk associated with that exposure to natural gas prices? And then are there some sites that are really subject to these what we call business-threatening effects of sudden and significant spikes in natural gas prices as we've seen reported? So we'll examine each one of these questions over the next 20 to 30 minutes. Now, all of the analysis that I'm going to show you today, I did using FisherSolve, which means that if you're a FisherSolve subscriber, you could do the exact same analysis. You could analyze the impact of changes in natural gas prices, or really changes in prices of any other input variable using FisherSolve. So I would encourage you to reach out to me or to one of the other members of the senior consulting team, and we'll be happy to give you some help on how you can do this type of work. I'll also note that today's presentation focuses on the North American market, but the same type of analysis can be done for any region of the world, and again, for any particular input variable. So let's take a look at that first question. Are there certain segments of the pulp and paper industry that are just more sensitive to natural gas price volatility? Well, as we can see from this chart, the answer to that is clearly yes. In North America, tissue and towel producers use about twice the amount of natural gas per ton than the next closest class of papers, in this case, packaging. Let's talk for a minute about what we're looking at here. So the y-axis of this chart is the natural gas per ton expressed in MMBTUs, millions of British thermal units. The y-axis is just the various major grades that we track in FisherSolve. So we see that tissue and towel producers use a little more than twice the amount of natural gas per ton than the next closest major grade. Now, there are a couple of things that drive this dependency on gas for tissue and towel producers. One of them is the low level of integration at towel and tissue sites. Now, what I mean by that is an integrated site has an associated pulp mill. Most tissue and towel sites do not have pulp mills, and we'll talk a bit more about that in just a moment. But another factor is that just in the method of manufacture, tissue and towel sites use more gas-intensive drying technology on the paper machines to dry the product. And so that also increases the use of natural gas for tissue and towel sites. So let's talk a little bit more about this notion of integration and how, or the lack of integration at tissue and towel sites, and how that affects and drives their use of natural gas. Of course, Pulping liquor is a byproduct of the chemical pulping process. So if a site has a pulp mill attached to it, a chemical pulp mill, it's producing pulping liquor. And pulping liquor can be used as a fuel source for the rest of the mill. And that fuel source, that pulping liquor, is certainly a low cost, and some would argue that it is a no cost fuel source because it is a byproduct of an earlier stage in the production process. Well, most tissue and towel sites are non-integrated. They don't have those pulp mills, therefore they don't have access to that low or no cost pulping liquor, so they're forced to use other fuels in their production operations. And we can see here that only about 13% of the energy at tissue and towel sites comes from that low or no cost pulping liquor. So we've seen that there are some segments that have greater sensitivity to natural gas volatility, but what about companies within those segments? Are there some companies that have more exposure to risk from natural gas price increases than others? And the answer again is yes. So let's go back and drill into the tissue and towel example a bit. Now let me tell you what you're looking at here. This chart, this bubble chart, the y-axis shows us the cost per ton from natural gas, and the x-axis shows us the amount of natural gas that's used per ton of production, and the size of the bubble represents the total amount that the company spends on natural gas on an annual basis. So when we look at this chart, we see that among towel and tissue producers, P&G clearly has more exposure than, say, Kimberly-Clark or Georgia-Pacific. In fact, for P&G, natural gas contributes more than 3 times as much to the cost of cost of production for a ton of product than it does for Georgia-Pacific. P&G uses considerably more, driven by a couple of those same 2 factors. They have no integrated facilities. They have no pulp mills from which they can derive pulping liquor to burn. And P&G uses more through-air drying technology, TAD, dryers in their manufacturing process than Kimberly-Clark or Georgia-Pacific. So because they don't have pulp mills, they don't have access to pulping liquor, and because they're using more through-air dryer technologies, that is driving up their use of natural gas among their competitive set. Now we know that natural gas prices are expected to rise in the near term. And let's talk a bit about how we know that, and maybe a little bit more of an explanation of this chart that we're looking at. So this data on this chart comes from the U.S. Energy Information Administration. And it focuses on the Henry Hub natural gas price. Well, the Henry Hub is located in Louisiana, and the pricing that you see on here is the price that's paid for natural gas at that Henry Hub. This is the proxy, if you will, for natural gas prices globally. Of course, we've all seen gold prices, we've seen oil prices. Those are all expressed using some industry benchmark. This is the industry benchmark for natural gas prices. So what we see here is this purple line is the historical spot price for gas at the Henry Hub. The green line is the short-term energy outlook forecast price that comes from the EIA. This blue line is the NYMEX futures price. And of course, again, natural gas is a readily traded commodity, and because of that, there is an actively engaged and traded futures market. This blue line shows the futures price, which tells us what traders believe how traders believe the price of natural gas is going to behave into the future. So if we look at this green and blue line, we see that towards the end of 2015, the expectation is that natural gas prices are going to drift up slightly from where they are today. But what really struck me about this particular forecast is this volatility that's associated with that forecast. So these two blue dotted lines represent the 95% confidence interval, meaning that statistically speaking, we can be 95% certain that the actual price of natural gas will fall somewhere between these two dotted blue lines. When we look out towards the end of 2015, we see quite a gap between the upper and lower bounds of that certainty range. The end of 2015, the upper bound puts the price, could be as high as just above $7 per MMBTU, but the lower bound is around $2.50. If we look at the spread just about a year from now that's expected, or the certainty range for this time next year, that price is even higher, close to $7.50 on the top end. So again, we can look at this and say, okay, the traders in the market believe that the price is going to go up, but there's a great deal of uncertainty about just how much. Well, fortunately, we can model some of that uncertainty using FisherSolve. Well, what I've done here is I've used the FisherSolve what if analysis feature to model in those various scenarios for natural gas prices. So this green line is the base case. That's the price of natural gas today. The yellow line is the natural gas forecast, and so you see it's expected to drift up slightly. The red line represents that upper limit of that 95% confidence range, and then of course the blue line represents the lower limit of that confidence range. So we can put all of these different scenarios into FisherSolve and ask FisherSolve to produce a graph for us that shows the impact on the cost for various companies if their input variables, in this case for natural gas, hit those variety of pricing levels. So what we're looking at is just for energy cost. Y-axis is the cost per ton, x-axis is just the cumulative production. And so I plotted three major producers here. So what we see is that for Procter & Gamble, the variance is very wide. So if the price is at that upper bound versus the lower bound, there's an $80 per ton spread. For Kimberly-Clark, the spread's a little less, $52, and for Georgia-Pacific, it's less, even more, $30 per ton variance between the upper and the lower level. So what does that mean? Well, we might assume that if an input cost, if an input price caused a manufacturer's costs to go up, we might expect to see a corresponding increase in the market price. If their costs go up, they may decide they need to pass that cost along in the form of higher prices in the market. But if the market price rose to offset the cost difference that would be experienced by Procter & Gamble, Kimberly-Clark and Georgia-Pacific would be a big beneficiary there. They would have sort of a windfall. But if the market price went up only enough to cover the cost increase incurred by Georgia-Pacific, both Kimberly-Clark and Procter & Gamble would see their profitability suffer. Now, I want to be clear here that natural gas price volatility is not an existential threat to any of these companies that we're talking about here. Procter & Gamble spends a lot of money on gas. We estimate that they spend about $1 million or $100 million per year on gas. But their net income is just north of $2 billion per year. So I am not at all suggesting that natural gas price spikes could represent a significant threat to these companies' long-term prospects. So if you're a Procter & Gamble shareholder, I'm not suggesting that you run for the hills. But I do think it's important that we understand how each of these companies' cost would change as these different input variables like natural gas changed. But let's keep that in the broader context of the size and scope of these companies. So we've seen how different segments have different levels of volatility, different levels of exposure to natural gas price. We've seen how within the tallow and tissue segment, some companies have more exposure than others. But what about other segments? Let's take a look at some of those. So if we look at packaging from a broad perspective, we see that recycled board producers have clearly more exposure to natural gas volatility than, say, liner board manufacturers. Recycled board manufacturers use more than 2.5 times the amount of natural gas per ton that liner board manufacturers do. And if we drill into that recycled board segment a little bit, we see that a lot of the companies here are pretty tightly grouped, but Sonoco clearly is separated from the pack. They have less dependency, they use less natural gas per ton than their major competitors. Now what I've done for each one of these segments is given you a little table that shows the top 4 producers in each one of these segments we're going to look at, the tons per year of production for each company, the number of sites that those companies have producing those products, and the number of those sites that are using natural gas. Again, y-axis is the cost per ton from natural gas, x-axis is the amount of gas that you're using per ton, the size of the bubble represents the total amount of money that they spend each year on natural gas. So let's look at container board producers. Of course, container board is a combination of liner board and corrugated. We've rolled those two together. And what we see here, again, is a pretty tight grouping of the major players. But notice how small of an overall exposure in terms of expenditure that PCA has. PCA spends very small amount on natural gas, say compared to IP. Now, IP produces a lot more product, and so they have more tons, and so you would expect the size of this bubble to be larger. But PCA has the ability to burn gas at 3 of the 4 sites that are producing these products. They're just choosing not to. They're burning other fuel sources there as opposed to natural gas. If we look at craft board producers, we see that Midwest-Vaco uses about half as much gas per ton as IP does. If we move on to look at uncoated free sheet, we see PCA. Now, these are the old Boise mills. PCA, of course, recently acquired Boise, so these would be the former Boise facilities. But PCA spends more than twice as much per ton on gas as Domtar does to produce uncoated free sheet products. Now, I've labeled Gorham paper on this mill, on this chart, not because they are a major producer of uncoated free sheet products, but because they were one of those sites that we saw earlier in the news headlines that actually curtailed their operations due to a spike in the price of natural gas. And this chart indicates perhaps why they had to do that. They use a significant amount of natural gas per ton, more than anyone else making uncoated free sheet in North America. If we shift now to uncoated groundwood, we see that Catalyst is clearly separated from its peer group when it comes to the use of natural gas. They don't use very much per ton, and their total expenditure on it is very small. Even though they have the ability to burn gas at all 3 of their sites, they're using other fuel sources to fuel the mill. Now, once again, I've added UPM's site. This is actually their facility in Madison. It shut down also recently because of a spike in natural gas. And once again, this chart indicates, well, yeah, that makes some sense because they have significant use. It adds a fair amount to the cost per ton, more so than any of their peers. They chose to shut the site down when gas prices spiked. If we look at coated free sheet producers, we see that SAPI actually has a very small amount of exposure to natural gas in terms of both the amount that they're using per ton and the total expenditures per year, much less so than NewPage. NewPage uses gas at all 6 of the sites that they have producing coated free sheet products. If we switch to coated groundwood, we see that Verso has significantly more exposure to natural gas than either Resolute or NewPage. Verso uses natural gas at both of the sites that they own producing coated groundwood, and they use it in considerable quantities. So let's summarize what we've talked about so far. We've seen that there is some difference across segments in the use of natural gas and the exposure. We've seen that North American tissue and towel producers have quite a bit more exposure to risk for natural gas price volatility than do producers of other types of products. And within tissue and towel, we see that Procter & Gamble has a higher level of sensitivity to changes in gas prices, and that's driven because of their lack of pulping facilities and their use of gas-intensive drying technologies. Now, the risk from natural gas volatility, or really the risk from volatility in any input variable, of course, well, for most input variables, of course, could be managed through hedging vehicles. Because gas is a traded commodity, you could use options or futures markets to hedge the risk of price changes. It's kind of like buying an insurance policy. But that insurance policy comes at a cost. So while it probably is advisable for companies to hedge the volatility, hedge their financial risks that come from natural gas price volatility, they will still have at least some level of increased cost. Because they've had to purchase that insurance, their costs will be at least somewhat higher than companies who don't have that exposure and who don't have to buy that insurance. Now, I also want to say at this point that I want to be clear that I'm not suggesting that using natural gas is bad or that the use of natural gas causes a company to be at greater risk than someone else. We're talking about natural gas because that's been in the news recently, and we've seen some of the impact that that has had. But natural gas has been, at least in North America, a lower cost fuel source than certainly oil. There are lots of advantages to burning gas, certainly from an environmental perspective and most often from a cost perspective as well. So I don't want you to leave this presentation thinking that I'm suggesting that use of natural gas is a bad thing or that companies are at higher risk because they're using natural gas. That's certainly not the case. What we're trying to examine is that given the potential volatility in natural gas market, what could the potential impact on these various companies be? And the other thing to remember is that we have been focusing on rising prices in natural gas. But remember that a company with a big exposure to natural gas would benefit if the price of natural gas were to fall. So again, it's not a good or bad thing that a company is using gas. We're just trying to examine the sensitivity to changes in that price. So let's get at this question about these short-term shocks from some sudden and severe change in natural gas price volatility. Here's an excerpt from the U.S. Energy Administration or Information Administration's Natural Gas Weekly Update. This was from back in January, and the first part of the text of the announcement talked about how there had been a slight drift upward in the price of natural gas. But this underlying part is what really caught my attention. EIA talked about these big differences, these large variations in price from on a regional basis. and they talk specifically about how gas prices in the Northeast United States in this particular week, there were some days that the price of gas jumped to over $70 per MMBTU. Now, we'll see in a minute that perhaps the normal price is around, say, $6 or so. So going from 6 to 70 is a significant jump. So as this was happening, and we saw from our earlier press releases, Verso decided to shut down the Bucksport mill for a couple of weeks, in part because of that big jump in the price of natural gas. And we've already talked about Gorham Paper and UPM Madison, but there was also a Huhtamaki site that shut down in the past couple of months, all citing this spike in natural gas prices in the Northeast as a reason for having to shut the facility down. So again, we need to think about this, and can these spikes in that natural gas price like that really have that kind of business-threatening impact to where a site would have to shut down? Well, let's take a look at that Bucksport example to see if we can find the answer. So we know that there's some variation in the price and the use of natural gas by region. Now, this is just a chart that shows printing and writing sites. And now on the y-axis, we've shifted from cost per ton to price per MMBTU. So how much are facilities paying for natural gas? The x-axis is still how much they're using. So we can see here that printing and writing sites in the Northeast United States, they use more gas and they pay considerably more for it than, say, their counterparts in the Southeast United States. Now, if we shift our focus to just those coated groundwood producers, because the Bucksport facility, it's primarily the grades they make there are coated groundwood products. So if we just graph only those sites making coated groundwood in the United States, we see here that Bucksport uses more gas per ton than most of their peers, and they're paying more for it because of the location. Now, all three of these sites are in Maine, and so you can see that the price that they're paying you would expect to be about the same because they're all in the same area. So because of Bucksport's high usage of natural gas, it's starting to become clear that a significant spike in the price of that natural gas could have a real impact on their business. So let's take a look at a cost curve for coated groundwood producers in the U.S. Now let me make a couple of comments about this particular cost curve, because this may not be a completely fair comparison for Bucksport, because Bucksport probably makes, in fact they do, they make a targeted set, a more narrow range of coated groundwood products. So if we wanted to focus in specifically on, say, only number 5 coated groundwood and maybe only those products within a certain basis weight range that more closely matched what Bucksport was doing, this cost curve may look different. And we can go to that level of detail in FisherSolve. But what I wanted to do here was to create just sort of a generic coated groundwood. So I included all coated groundwood products in here. So this captures everything. So we could back out at the site level and do an across-the-board comparison of how changes in natural gas prices would affect these sites. So with that, providing that context, we see that under normal circumstances, Bucksport has a gap from the low-cost producer. That gap is about $140 per ton. Bucksport's cost, in looking at it in this broad fashion, is about $140 per ton higher than the low-cost producer in the United States. But look what happens when we start modeling in some higher gas prices like we have seen. Now, once again, I used the what-if analysis tool within FisherSolve to say, I want you to change the natural gas price from that normal $6 per MMBTU. I want to change that price to $60 because we know that it reached that level, and in fact, in some cases it was higher than that for some periods of time in the Northeast. I only want you to apply that $60 figure to those sites that are located in the Northeast. Well, look what happens to our cost curve when we do that. Bucksport shifts all the way over to the right. They become the high-cost producer, and that gap grows from $140 per ton to $430 per ton. Well, that's an unmanageable price gap. And so when we think about it in this context, it's perfectly rational and reasonable that Verso would decide to shut that facility down for a while rather than to continue to produce product at such a competitive disadvantage. So we have certainly seen that it is true that sudden and extreme spikes in the price of natural gas can have these business-threatening impacts on an individual site. And we also see that right now, conditions in the Northeast make that region a little more susceptible to harm from price volatility. And part of the reason for that is that there is a real pipeline capacity problem. It's not so much of an issue of there's not enough natural gas in the ground. There's not enough pipeline capacity to get the gas delivered to the people who need to use it. So that's where the bottleneck is. It's not an availability of the natural resource. It's an availability of a delivery system to get that natural resource where it's demanded. So any site with a heavy dependence on natural gas is subject to potentially market tilting impact. And in fact, that's true for any cost input variable that we would want to look at, and with natural gas or any other element that we would examine, understanding and managing the risk is really key to insulating oneself from damage.